Joe, going to turn over to you. A lot of things to talk about here. Is this the end of the so-called rotation after a 5-day slide last week when we saw the S&P equal weight outperform? Is this just simply things getting back to normal as we're nearing the end of this quarter? Tomorrow, obviously, the quarter end.
Well, the end of quarter generally brings a lot of volatility and a lot of confusion for investors because it tempts you for the wrong behavior. Understand a lot of the dynamics surrounding end of quarter relates to index rebalancing and a lot of institutional capital that's going to be rebalancing and going to different places, maybe going from equities into fixed income. But I think what's important to really highlight is that we keep talking about the rotation that's going on in the market. And I think it's important, and I'd love to hear what everyone thinks about this, not to try and identify which is going to be the winner at the end of the year. Because I feel like you're getting rewarded for being in both places. You want to go S&P equal weight? Okay, you're up 10% year to date. S&P equal weight more recently has pulled ahead of S&P market cap weighted. There was a period during the Iran conflict that S&P market cap pulled forward. So look at today, Frank. S&P equal weight's down. S&P market cap is up 90 basis points. Here comes the MAG 7 once again. They're not really the lag 7. You want something on the 52-week list? You want to pick from energy? You could look at Valero. You want to look at healthcare? I've got Lilly. I've got Merck for you. Industrials, CSX, Honeywell, and then technology. Once again, semi-equipment working. It's your Applied Materials, KLA Corp, Lam Research, Palo Alto Network stuff. So I just don't think you want to make the mistake to try and concentrate in one particular direction because the market is rewarding you for being patient and kind of sitting in a variety of different places.
Yeah, patience is certainly a virtue. Sorry, Steph, I cut you off.
No, I was going to say I agree 100% with what you're saying, but I think we just keep it simple. The reason we're seeing other sectors and stocks work is really because the economy is doing much better than most people expected, and therefore earnings will actually be more broad in general, not just tech. And by the way, tech is driving me crazy. I don't know about you guys. It's like this flip-flop between semis one day, software another. I think you just call it a day and own both of them, have a basket. But I do still think that some of these other sectors are even more attractive, like financials, like technology, some materials, some ag stocks, some discretionary. Discretionary is getting hit really hard today. I think you're getting opportunities to get some really best-in-class companies like Starbucks or Dick's, but it all comes back to the economy, and the economy is growing for two reasons. The consumer is consuming, and we saw that with retail sales 2 weeks ago. We also see personal income better than expected. We also see wage growth continue to be 4 to 5%, and the labor market weekly claims continues to be very, very low. And then you have this whole industrial boom with AI revolution. We've all been talking about it, but it is encouraging to see the PMIs also picking up, the best since 2022. That's really encouraging to me. I think by far the most important thing, though, is that oil prices are down 39% from their highs. And that is really very, very positive, not only for consumer, but businesses, but also maybe the fact that we've seen peak inflation, because I think that's what the bond market is telling you with yields coming down.
All right. Jenny, I want to come over to you. So Steph's saying, own a basket, own a variety of things. But right now I'm looking, 5 of the 7 MAG 7 are leading the S&P right now. I'm looking at Alphabet, obviously joining the Dow, Amazon, Tesla's in there, Meta's in there as well. Entry points matter. We often say this here on the desk. Is this just more of an attractive entry point for the MAG 7 after almost 6% pullback last week?
I think so. And actually, in our disciplined growth strategy, we own Meta. And just on Friday, for accounts that didn't already own it, where they came in and the stock was trading in the high 700s, we didn't buy it. Because why would we buy it at 700 when we think we can get it cheaper? So on Friday, we put Meta into portfolios that didn't own it already. So yeah, I think so. But with respect to Steph's comment about being broad, she wants you to be broad within technology, and I think you extrapolate that out to the broader market too. It's just, I think
many sectors,
yeah,
many sectors.
There's a creativity that's finally at play that was missing last year. And Steph, you said tech drove you nuts. Tech drove me nuts last year because I thought there was such a lack of creativity by investors to only say, hey, AI, where's the most obvious winner? And this year we're seeing people broaden out, and they're starting to say, like, hey, real estate investment trusts, healthcare, insurance, like we talked about a few weeks ago, Joe, energy. AI, if it fulfills a quarter of its promise, is going to have such breadth in who the beneficiaries are. And that's what we're seeing right now. We're seeing people start to realize how broad-reaching, how far-reaching it is. And it hasn't gobbled up the consumer in the way that was anticipated even 6 months ago. So I'm feeling okay.
Well, in all fairness, there is some dispute about how deeply it's impacted the consumer. I don't know if you guys read Ed Yardeni over the weekend. He said it's boomers that are really holding up the consumer economy. They're giving money to their kids and their grandkids and pushing it. So people have been impacted by higher gas prices and certainly by inflation.
It's always a K-shaped economy.
Gas prices are coming down.
Wait, can I just say one thing?
That's my point.
I was at the real estate conference 2 or 3 weeks ago, and I was listening to Mid-American and American Homes for Rent, right? And both of them, so apartment rentals, and both of them were saying that younger cohort, the sub-35, was holding up not only particularly well, but they were holding up really well and not needing to have co-signers at the same rate they used to. So I hear the Yardeni point, but I think this is one of the nice things when you look outside of just, who's buying Starbucks or whatever, and you look more broadly at the consumer. What I took away from that conference was such a surprise that the okay, kind of call it 20 to 35-year-olds were holding up better than people expected. There were not delinquencies on their rents. They did not need the co-signers. So I think it might be a little better than we all want to say it is.
I mean, let's hope so.
It seems like there's a predisposition to want to complain about everything, to want to complain about inflation.
It's always
just human nature, isn't it, though?
Yeah.
The consumer is the least of my worries.
Me
and
too.
I don't have that many worries. But look, I just mentioned this. AAA national average for gasoline per gallon is down to $3.99. It topped out at $4.50. So that's a reduction of about 11%. Steph, you mentioned declining price of crude oil, and we all know that gasoline trails the declines in terms of time. It takes a little time for that to flow through to the price of the pump. So more relief is coming for the consumer. And let's face it, the labor markets are strong. We've had 4 months of labor job creation in the monthly labor reports. You've got the weekly initial jobless claims low. So I find little to worry about with regards to the consumer. And with regards to the markets, I'm going to key off of what all three of you have said, but maybe go back to you, Joe, because I feel like, Joe, quite often when we speak in our opening monologues in the A block, you quite often talk about the rotation. The rotations, we will admit, have been coming fast and furious for the last few weeks. And what I think I heard from you, which I agree with, is, hey, everybody, settle down on the rotations, because what's hot today may go cold tomorrow. Something else will be hot. If you are a broad-based investor, like most of us are, then you can sit patiently and wait for those sectors to perform. I'll give you an example, okay? Healthcare, which we'll talk about later. 6 months ago, we weren't even talking about it because it was so left for dead. Now that's where the hot sector is. Right now, energy is cold, obviously, because of the decline in crude oil prices. But that's a sector that you can patiently wait, both because of the dividends and the share buybacks, and I'll add on top of that attractive valuations. The point being here, Joe, you are excellent at calling the rotations, and I admire you for it. For somebody who's longer term, who doesn't want to play the rotations because I'm often offsides on it, this is a period where I can pick my stocks, I can pick my sectors, and patiently get good returns from that.
All right, so I agree with Jimmy. And my point is that you don't want to play the game of trying to pick the rotation moving forward. The analogy would be in baseball, platooning two players at one position and then saying, okay, all season, well, who's going to be my starter? Who's going to be my starter? I have to pick a starter when each of them are hitting 300 and getting you 18 to 20 home runs. Keep platooning. It's not as if S&P equal weight isn't working. It's not as if S&P market cap isn't working. They're both working. So there's no need to try and pick which one is going to be the winner in the second half.
All right, so a lot of positivity, a lot of optimism here. By the way, RBC's Lori Calvasino raising our S&P price target up to 8150 from 7900. That's about a 10% gain from current levels. Basically saying as long as recession fears remain low, which everybody seems to think those recession fears will remain low, and Fed hikes remain moderate, we expect the pullbacks in the S&P will not exceed 5 to 10%. Moderate hikes? Can the market move higher with moderate hikes?
I don't see hikes in 2026. In fact, I think the high is in for yields. I've said that for the last several weeks. I believe that to be the case. I think the biggest concern that the hawks had was that the price of oil was going to continue to rise, move above $100 and sustain there, that it would take way longer to open the strait that was anticipated. To Steph's point, oil has come back down to $70. It's done so very quickly. We're sitting $2.50 above where we were at the end of February before the beginning of the conflict. And I think that's going to begin to show up in the inflation numbers. I think Kevin Warsh did exactly what he was supposed to do in his first press conference. He was working against the narrative that he was put there by an administration and he would be an extension of the administration. He spoke with a very hawkish tone, but in reality, based on the evidence he has in front of him for the remainder of 26, I just don't think there's justification for there to be a rate hike.
I mean, at the end of the day, it's really about earnings. And that's why I often cite the economic data points, because in a 2% GDP world, you can grow something like 10 to 12% earnings. We're in a 3 to 3.5% GDP world, and we're expected to see earnings this year be 20% plus. Last quarter, it was 28%. Surprised everyone, even the bullish of the bulls out there. So to me, it's all about earnings. If the economy is doing what it's doing, and then you have this revolution in AI that we have never seen before in our lifetime, that is a combination that is so powerful. And if we can do 20 to 25% earnings growth, this market is going to edge higher and higher. And again, you are going to continue to see the broadening out.